Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your 247th VideoCast podcast for the week ending July 11th, 2024. What an exciting day. I almost felt like, gosh, I have nothing to say now, but actually we've got quite a bit to cover, so we'll kick it off with some updates. This was a picture, for those of you who like the behind-the-scenes stuff, my first time on Varney & Company. That's David Asman and Lauren Simonetti right there on the desk. That was fun. Then this was the green room right back here. That was for the studio. This is outside for those of you who are new to us. That's right outside on 6th Avenue and 47th Street. And this is cool. I thought you'd like this. These are teleprompters. This is me sitting at the desk. And this big screen here, they actually play the show. Basically, you see it on TV as you're doing it, and these are their teleprompters, and that's the camera that they tell me to look into when they introduce me, and that's a weird picture of me not looking at the green dot on my camera, so that's that. Wanted to put this out. Charles Payne sent this to me. You all know him from Making Money with Charles Payne on Fox Business. He's on the board of the Boys and Girls Club of Harlem. This is near where he grew up, one of the greatest of all time American success stories. And it's to benefit the Boys and Girls Club of Harlem. It's July 17th, next Wednesday from 6 p.m. to 10 p.m., 521 West 145th Street. It's Spirits and Cigars soiree. I don't do much spirits and I don't do many cigars, but it's going to be some great company and I'm looking forward to it. Lou Bassanese, many of you know from Cavuto, he's a regular guest, and from Varney & Company, he's a regular guest. We'll be there. We're going together. And by the way, Lou is the want to acknowledge him. He actually made an introduction that got the ball rolling at Cavuto, so I'm very grateful for him on that. And he's fun to golf with as well. Kelly O'Grady and her husband are coming. Many of you know Kelly O'Grady. She's pretty much on every show every day. Then you've got Will Leverett. He's a floor trader that's going to be there. So if you meet him there and you want to get a tour of the New York Stock Exchange, he's your guy. Jacob Sonnenschein. Oh, and if you've got institutional trades to do, he's your guy. Equity trades. And then Jacob Sonnenschein, reporter from Barron's, will be there. And these are just a few of us that are going. So, and of course, you get to meet Charles Payne in person. So you can actually just hold up your phone to this if you're watching this on YouTube and register for your ticket. Hope to meet a bunch of you there and support a great cause. And if you can't get this code thing to work, just contact me and I'll send it to you. And will be a fun night. Want to thank Preston Mizell for having me on Varney & Company on Monday. We covered a ton of stuff here. That was with David Asman and Lauren Simonetti. We're going to watch it now.
Joins us now. Tom, is the market spread a little too thin? We've been focusing on these few companies, particularly those dealing with AI. It's not that the rest of them are doing terribly, but these few are pulling the whole market indexes up, correct?
No question about it, David. There's a saying you're probably familiar with: the last shall be first. I think the second half is going to flip the first half on its side. You had the Magnificent Seven, top 5 stocks, were responsible for 60% of the gains in the first half of this year.
Wow.
That's going to change for 2 reasons in the second half. We're on the cusp of a sea change. We're going to get more participation. And the first reason is earnings composition. So in the first quarter, for instance, the Magnificent Seven had 50% earnings growth. The Unmagnificent 493 had negative 1% earnings growth. By Q4, it's going to be...
So just, again, to focus on it, 493 stocks had negative
1% earnings growth in Q1. By Q4, it's going to be 17% earnings growth for the Magnificent Seven, so a deceleration in growth, and 19% earnings growth for the unmagnificent 493. So, Warren Buffett says whether socks or stocks, we like to buy quality merchandise when it's marked down. There's plenty to find.
Well, let's talk about your picks. Crown Castle, I understand, has pretty good dividends. Tell us about it.
Yeah, so 6.5% dividend yield. They have 40,000 cell phone towers. It's a REIT. It's going to trade with interest rates. So we believe we're going to get 1 to 2 cuts. The market is now pricing that in. About 70% chance of a cut in September, 72% chance of 2 cuts by December, 95% chance of 1 cut by December. That's going to help all REITs. They have a fiber business that they're going to sell off, deleverage the balance sheet, a new CEO. In the meantime, you get a 6.5% dividend.
6.5% dividend.
6.5% dividend paid while you wait.
Okay, very quickly, GXO Logistics, they're kind of a warehousing company, right?
That's right. Outsource logistics, supply chain outsourcing. This is one of Brad Jacobs' companies. He just wrote a book, How to Make a Few $1 billion. He made a few $1 billion with URI. If you invested $1 million in United Rentals, you got 47x, $47 million. If you did it with XPO, you made $31 million on $1 million, and now GXO Logistics spun out. They're estimating they're going to nearly double adjusted EBITDA by 2027, and the business will grow from there.
Good stuff. GXO Logistics. Tom Hayes, great to see you.
Thanks for having me.
Thank you very much, Tom. Appreciate it. Lauren, you're looking.
And we're back. And then and the reason we do this is to give you my broad overview thinking. And it's interesting, I've been on Fox a number of times in the last couple of weeks where I said, listen, we are on the cusp of a sea change. It's going to move from the Magnificent 7 to the unmagnificent 497. And I emphasize this. I had the fortune on Tuesday to be on Coast to Coast with Neil Cavuto and did 2 segments. One segment at the top of the show and one segment at the end of the show. And this is important. And then we're going to put this all together into the context of this week's podcast VideoCast and how all the pieces are finally coming together for the puzzle. And that's why you saw a monster amazing day like we saw today. So listen in here.
So right now, to Thomas Hayes, the chairman and managing member of the Great Hill Capital. Thomas, one of the things that I was trying to glean from Jerome Powell is the stuff he said in between, where he talked about the risk of holding rates high for too long. That's a real palpable danger. And I got the impression again and again, he doesn't want to invite that. Now, I don't know whether that signals, depending on your point of view, a rate cut this year. But it's the first time he has pounded that theme. There is a danger to just keeping rates where they are now for too long. I guess the distinction here, what is too long? What do you think?
Yeah, I think it's already too long, Neil. He acknowledged clearly the considerable cooling in the labor market that we saw Friday, unemployment ticking up to 4.1%, and the market and acknowledging his dual mandate. So the market has pretty much now priced in 97% chance of 1 cut before the end of the year and a 75% chance of 2 cuts before the end of the year. He's simply too restrictive. 200 basis points above inflation is meaningfully restrictive, and we're starting to see the economic data slowing pretty quickly.
So when he talks about keeping all options open, but he hints that he's going to need, I assume when he's talking about friendly inflation data, what's coming down the pike soon that could close the deal on that or push it back?
Yeah, I think tomorrow, certainly this week, Thursday and Friday, we get the CPI and the PPI. Headline's supposed to be 3.1% year on year, but 0.1% month on month. And PPI, which is a leading indicator, is supposed to be 2.2% and 0.1% month on month. I think anything in line or below with the labor market cooling confirms what the market is already saying, which is 75% chance in September, 97% chance in December. I think they've got to move.
What do you think of how it looks if you move in September before the election? There's some cover doing it afterwards, but you're quite right. History has shown time and again the Fed has moved in election years, sometimes very close to the election itself. But how will that go down?
Yeah, I think both sides will use it one way or another, whether they move or they don't move. They'll blame the Fed. That's a natural action by politicians. But at the end of the day, the economic data is dictating. As a matter of fact, June was the first month since October 2020 where 0 global central banks hiked rates. And the last time before that was March of 2009 and December of 2001. All of those times were good times to buy cyclical stocks, meaning maybe we're going to get a reprieve from some of these leaders that have led the first half of the year.
Well, the S&P and NASDAQ with the gains today, modest though they are records yet again. We keep doing this day in and day out. Not so much the Dow. What do you read into that?
Yeah, I think the market is really in a holding pattern until there's some clarity on the rate cut coming in September. We're looking for the July meeting. We're looking for the inflation data. We're looking for earnings. We're looking for everything but politics. No one really seems to care. The market doesn't really seem to care about politics right now because they know what they would be getting with Trump. They know what they would be getting with Biden. And if it's not Biden, we're not going to know that until August 19 at the Democratic National Convention, because they don't want to give up the $100 million war chest by him stepping down too early.
They would have to give that up if, for example, it's not Kamala Harris. Otherwise, it would go into a pack. You're quite right. You know, the markets generally, from my history, and I'm very, very old, tend to sort of get the market's attention late summer, early fall, more often early fall, before they move based on what they think might happen. How do you see it going this year?
Well, you have expectations for almost 9% earnings growth year on year this quarter. So earnings is going to be pretty critical. And the last few quarters, the bar has been very low. The bar is kind of high here. And even if you get a beat, maybe it's only 10 or 11% versus what we've been seeing of 3% beats. So I think we're going into earnings season with very high expectations. And what I found, Neil, is the secret to happiness in life is low expectations. So let's watch out. I think we'll probably continue that seasonal summer strength for a few more weeks, but I think as we get into fall, maybe a bit more choppiness, a bit more rotation under the surface that we should be alert to.
Well put, Tom. Don't wander too far. By the way, I built a career on low expectations, so there's something to be said of that, young man. But Thomas, again, look forward to talking a little later in the show. Down about 29 points, as I said. We're seeing pickup in the S&P and the NASDAQ, and of course they hit records the last couple of days. Anything more, you got another record. Edward Lawrence in the meantime.
And we're back. And segment number 2.
Company, as you know. This headline in Barron's really got to me because I love the simplicity. The biggest risk to the Mag 7 is how well they're doing. And now that Tesla's doing well and just scored, or it looks like it's going to score its 10th consecutive gain. It's up almost another 5% today. They're doing well. They're all doing well, and they're all making money for their shareholders hand over fist. Thomas Hayes back with us, the chairman and managing member of Great Hill Capital. Tom, you don't want to get in the way of a parade like that, but by the same token, the longer you hold on to these issues, you know, the more they take up your portfolio. That might be fine when they're going up. It might be risky down the road. How do you play that, or how do you tell customers how they should play that?
Well, Neil, the theme of the first half, 60% of the gains in the S&P 500 were attributable to just 5 stocks. In the second half of this year, that's going to be flipped upside down. The plates are going to move under the surface without causing an earthquake. I know a lot of people are worried about a big correction. That's not going to happen. What we're going to see is the unmagnificent 493, yes, I coined that, are going to outperform the Magnificent 7 in the second half. And there's 2 key reasons for this, Neil. Number one is earnings composition. Q2 is going to be the first quarter since 2022 that the unmagnificent 493 have positive earnings growth. And by Q4, unmagnificent 493 are going to grow earnings 19% versus the Magnificent 7 only 17%. So that's reason number one for the sea change.
Very interesting. Of course, referring to the S&P 500 and the 493 that could not keep up with those 7, that might start reversing. That's an intriguing development because it could at least level things out a little bit. How do you feel about technology in general? And, a lot of people have been buying technology ETFs, NASDAQ ETFs, the ETFs that mirror the performance of some of these big names. Overdone or just about right?
I think it's not overdone if you look out long term. I think in the short term, some of these stocks have gotten ahead of themselves, and I don't think they have to crash in the second half. I know everyone's comparing NVIDIA to Cisco, but I do think that there'll be flatter performance, and you're going to see some of these laggards, kind of the last shall be first theme in the second half. And the second part of the reason for that is the Fed is going to cut, and that's going to enable some of the cyclicals, some of the dividend payers. Small caps earnings growth is accelerating into 2025, and REITs and international will be able to outperform. So maybe you see less of a performance in the indices, the market cap weighted indices for the second half, but you see dramatic opportunity under the surface where some of these laggard stocks really start to gallop, kind of like we saw the last 2 months of 2023.
Just to be clear, you're talking about the REITs, real estate investment trusts. You like them in this environment?
I do. You know, we own Crown Castle, which is a tower company.
Absolutely.
They're anything interest rate sensitive. I think once we get that first cut in is really going to accelerate. They've underperformed because of this aggressive tightening cycle.
Good stuff. As always, Tom, great seeing you again as well. Thomas Hayes, the chairman and managing member, Great Hill Capital, knows of what he speaks. That's an understatement. And so does this next gentleman.
And we're back. So that's all the context that you need to know for the global macro. The key thing today after the inflation report, look what happened. The big change is that the odds of a rate cut in September went from just a few days ago, I was talking about 70 and change. It's now a 90, almost 93% chance of a cut in September. And that's why all of our stocks went through the roof today and are going to continue to follow through. I can't tell you what's going to happen tomorrow. Usually they do a fake out, but the key is we're here, ladies and gentlemen, and look at this beautiful map. And if you remember last week, by the way, I started talking about, like, you know, we've had these monster runs in our Google and Amazon since October 2022. Those of you who've been longtime listeners, you know we were buying it in the hole when you couldn't give it away. And we talked about last week, maybe we want to lighten up. We did, and we still own some. We still own a bunch, but we've taken a lot of our principal off the table and are now just riding the house's money for the long term. And you can see NVIDIA down. I mean, look, I got to tell you, I mean, anyway, NVIDIA down 5.5% today, and banks are up, and energy's up, and REITs are through the roof, and industrials are up, and banks. I mean, this is like Christmas for me. I got to be honest with you. And then international stocks were up. China was up. Holy cow. China was up. Cooper Standard, I think, was up like 10% today. Pretty darn fun day. Dollar was down. Bonds were holding in there. The Japanese yen actually had a big rally yesterday, and people are now speculating about intervention. The bottom line is everything we've been talking about is finally just all clicking on all cylinders. It's kind of like playing when you're putting, your short game, your driver, and your approach irons all work at once. That's that. Haven't been able to replicate that 81 from last week, but we'll get there. I told someone I'm going to get down to a 9.9 index by the end of the year, even if I have to play in a snowsuit. If it takes me till January 1, I'll do it. Down to a 12.2, but I got to stay on top of it. Anyway, leaving that aside, what else did I want to cover on this? That's good. Next, let's look at some of the stocks of what's starting to happen. Now, these are monthly charts. I didn't do dailies, but so you see these big day rallies like you saw today, and the temptation is to think, oh my God, that's too big a move. You know, I missed it. But you can see here, these are just getting started. And it's kind of, you know, it's so interesting. And I've been saying in the last few weeks that the Magnificent Seven have been trading like all-time highs. And the rest of the Unmagnificent 493 were trading as if the market was trading at new lows. And so, yeah, if you wanted to like lighten up on some Mag 7, the exposure that you had, but to really get aggressively short or hedged when there's so many stocks that look like they're ready to take off was the conundrum. And that's why we haven't gone into these aggressive tactical hedges. We've just taken the opportunity to lighten up on the FANGs that or the two Mag 7 stocks that we've had monster runs since October 2022. And no change other than adding opportunistically with all the stocks that are now starting to really rip. So Advanced Auto Parts just getting off the mat. I mean, Amazon's going to be fine. We took a little bit of profits there. This has been a big run from 80s and change to 195. So we don't want to be pigs. We think we could probably add back, similar to what we did with Intel last year when we ran it from 25 to 48. And then we rebought a ton at 29 and 30, and now it's going back up again. I think maybe we get an opportunity to buy Amazon at 150 again with some of the profits that we took off. But I do think this is going to go a lot higher over the long term, so I'm not at all bearish on this. It's more of a kind of tactical play, just knowing where we are. Boeing, keeps going up on bad news. This thing's going to be great. They pled guilty for fraud. They'll write a check, and they're off to the races, and people can't get planes for 20 some odd years. Baba up 9% in the last 11 days, so that's starting to move. Remember, shoulder, head, shoulder, shoulder, head, shoulder, and then you get the parabolic moves. I think we're right on the cusp, ladies and gentlemen, and I'm pretty excited by what I saw today. Finally, Bank of America has been a beast for us. That thing keeps going. I think that's got a longer way to go over the next few years. Even Baxter had a rally today, which is exciting. This thing has just been building this base for so long, just like it did in the tech wreck here and the great financial crisis. A similar thing. You just got to be patient through it. We'll talk about patience today, but this thing is just getting started. Citi has been a beast for us, and it's tempting to want to take profits, but it's like the M&A cycle hasn't really started. The IPO cycle hasn't really started. Do we really want to sell just because it's doubled? No. I think we got a chance here. We could have a secular breakout and start to work back and reduce the share count. So, yeah, we'll see. But, again, we'll have some volatility in front of the election. We'll have some choppiness October, November, but not in these stocks that are just getting going. Crown Castle was through the roof today. I think it was up. Oh, man. I got to pull up the daily chart here. By the way, this shows the Russell 1000 value to growth off the hook, off this bottom, ripped higher today. Let's see if we can get some daily information here. Advanced Auto Parts was up 5% today. CPS was up 10.6% today. CCI, let's see, up 4.66% today. What was Baba up? Even Baba was up 3.3% today. XBI Biotech ripping through the roof, breaking out here of this range that it's been stuck in for years, up 2.6% today. So all these things are starting to click. Why was CCI up today? Interest rates, ladies and gentlemen. We got to a 93% chance of a cut in September. That's all you need to know. So here's everyone crowding into this on one side of the boat. This is where the opportunity is starting to shift, ladies and gentlemen. Pretty timely, the opportunities I had to speak the last 2 weeks. Cooper Standard, big day. Why is this so small? Control 0, Control plus. Just see here, resend. All right, it is what it is. Comstock was up today. Diageo was up big today, and that one is just getting going. That's it. Why? Well, partially because it's a dividend payer, 3% dividend yield. All the dividend stocks now that rates are going down are going up. That's going to be a secular, unbelievable opportunity. Disney just kind of sitting in this range. We still love Disney. Emerging markets. So look at this, ladies and gentlemen. It's starting to break out above this range. We talked about that. Weaker dollar, rates come down. International stocks go up. China's going to follow. We're going to talk a lot about that today. Generac was up bigly. By the way, you got that hurricane. Burn we'll talk about. GNRC. That's been a beast since the 70s and 80s. It's now 148, up 4.45% today. I mean, we're having some fun, ladies and gentlemen. Google, look, I think it takes a break. I think this is a similar thing. Why did we trim when we think it's going to go a lot higher long term? Because it can consolidate for years, but I think more likely than not, we'll have an opportunity to rebuy maybe around 150. Not to get too cute with it, but we also don't want to be pigs. We were buying in October. 83 was the low, 90s, and now it's 185. Anyway. So again, GXO was up bigly. GXO up 7% today. I mean, it's Christmas, and we're just guys. And the thing is, people keep asking me, should we get short into the fall and all that stuff? You want to get short this stock in the hole? We buy in the hole. We don't get short in the hole, ladies and gentlemen. Hormel was even moving. That's a dividend payer. Intel's had a good few days, up from 29 to 33.50 in a couple of sessions. It got up to 35. Small banks, we've been talking about the regional banks. They're starting to get their, they're putting in this base, and now they're getting ready to work higher. Very exciting news. And a lot of this commercial stuff is going to get bailed out if we get 2 or 3 cuts, because then the banks are going to want to play again, and they're going to want to extend and not take the mark. So this is good. 3M keeps going up from 68 to 105. I think this is going to keep working higher over time. Even PayPal was up today, which is exciting. By the way, there was the Europeans hit Apple in Europe over their monopoly, which forces the other players like PayPal back on the phone, which is pretty exciting. PayPal was up a couple points today. Range Resources, we just keep holding it. That's got $60 of intrinsic value, 410 basis. This is going to be, it's close to already a 10 bagger, but this is probably going to be a 15 or 20 for us. It takes a few years, but they don't give away multi-baggers for free. These are just some stocks. Stanley Black & Decker, another dividend payer that we've talked about, own monster few days. It's up about 10% in the last few sessions, 4.65% today alone. Do I sound like I'm having fun? How about VF Corp? Wearing my Vans right now, was up 5.3% today. So we're hopping. Look at this XBI, guys. This is breaking out of this range right here, and it's going to start to move higher, a lot higher. This one's taken a while, been kind of just grinding sideways since 2 years, building a huge base, and I think it's got the space to go. The longer the base, the higher the space. This thing's got some legs, and we love that. And we never lost faith. Why? Because we don't trade on leverage. We know what we own. Our leverage is very modest. So as long as this thesis, deals and drugs, stays intact, we stay in the position, and we eventually get rewarded big time or bigly. All right, let's go through some data. We've got a ton. And, okay. It looks like this 7:30. It looks like Biden finally got to his conference an hour late. So anyway, all right. First chart I referenced in one of the Cavuto things. This is the first time since October of 2020 that 0 central banks were hiking rates. This was a brilliant time to buy cyclical stocks in October 2020, and you made a ton of money. And the time before that was March 2009, another brilliant time to buy cyclical stocks. And before that, late 2001, another unbelievable. These were like the 1, 2, 3 generational times to buy the type of stocks that we own right now that are starting to gallop. And it just happened again in June. So I'm excited, in case you can't tell. Bull Bear indicator indicates that we got some room to move. It's not fully extended. Largest inflow into bonds since February 2021. We've been talking about that. I think the 10-year yield got down to like, let's see what it got down to today. I think it was like 419. And those of you who remember when we were back up at 470, I kept saying, everyone's going, oh, we're going back to 5. I said, nope, we're going to 375 before we go to 5. And here we are at 419. Moving along. So bond inflows. This is Zero Hedge. U.S. added 1.8 million part-time jobs and lost 1.6 million full-time jobs since June 2023. So this is just points to the weakening labor market, which gives the Fed ample cover. I have some friends that think July is a live meeting. I think that's just too optimistic. Look, I'd welcome it because that means they may only have to do 1 or 2, but I think it's now September for sure. Seth Golden put out small cap multiples suggest 10% annualized returns over the next 10 years versus 3% annualized returns for large caps, which has been the case all year, cheap until they aren't. I like this. I don't know if it's as black and white as that, but that basically means passively you double your money every 7 years. Actively, you get these stocks that gallop and become multi-baggers like we believe with Cooper Standard. Again, all this is opinion, not advice. Go to hedgefundtips.com, click on terms. We only deal with family offices, small institutions, and ultra-high net worth individuals, accredited investors. We don't know your financial situation. Consult with a financial advisor before you do anything. Okay, back to our regularly scheduled programming. Delinquency rate of multifamily housing. This is kind of interesting. I think this is mostly in the super fast states like Florida and Texas. A little bit of oversupply starting to happen. I see this and I start to think opportunity. So we'll see what happens there, keeping our eye on it. But if rates come down, if we get a quick 1, 2, 3 cuts, that's going to put a lot of cushion, a put under that market. Private sector payroll growth, 3-month average, again, back to 2020 levels. More than enough cover for the Fed to go. Inflation, we know all that. Data centers use more electricity. Altogether, data centers use more electricity than most countries. Only 16 nations, including US and China, consume more. That's mind-boggling. And guess what that's going to mean? Natural gas out the wazoo, which is why we love our Comstock and our legacy range resources. Comstock is new. Legacy range is legacy. EPS is tracking a typical non-recessionary year and then picks back up June. So that's right on track with if you take out the financial crisis, Y2K and COVID, we're right on line, which means they start to reaccelerate the second half. If you put them in, we're doing dramatically better, and 2025 estimates keep going up, so that's positive. Analysts are predicting margins getting back to highs in the second half and setting new records in 2025. This is probably a function of some aspect of AI, which is very positive, among other things, and greater efficiency. So this is very good for earnings. Corporate sentiment has improved to a record level. That's what you saw out of 2009 and what you saw out of 2020 as well. So you tend to get follow through for many years. Hyperscalers are expected to drive most of the CapEx growth for S&P in 2024. This will be no different in China, and we're going to talk about some of the amazing news about Alibaba's cloud. Rail and freight carloads continue to rise, pointing to the manufacturing recovery we've been talking about, benefiting cyclical stocks. And my favorite stock chart, ladies and gentlemen, the destocking cycle likely hit the trough. You think? Look at this. It's almost back to the zero line. This was where you wanted to buy all of them. We did. this is where we're going to take advantage until it gets way to the top of this cycle. And we've got doubles and triples in all of these companies that have gone through the destock are now restocking. Companies like Generac, which is almost already a double, Stanley Black and Decker, which is just getting off the mat, Intel, you name it, it's happening. Now, this is the chart I referenced with Neil Cavuto. Q2 is expected to be the first EPS growth quarter for the unmagnificent 493, term I coined. And now they're going to start to catch and exceed the Magnificent Seven in terms of earnings growth. That is, along with the Fed, the key reason why you're going to see outperformance of the 493 small caps, dividend payers, international, China, because of this exciting development. Payrolls, we covered all that. Layoffs, blah, blah, blah. Okay, 9% earnings expectations. That's a big deal, guys. I covered that on Cavuto. Where are we going to see the biggest year-on-year earnings growth? Well, consumer discretionary, energy is back, financials are back, healthcare is back 16.7% year-on-year. Technology will still be strong. Real estate's going to have some growth, communication services and utilities. So 9%. The key here is if you get the normal 3% beat, it's one thing when you expect 3% earnings growth and you get 6. It's like, wow. If you're expecting 9 and you get 11 or 12, it's not as big of a wow. So, but with the vast majority of earnings concentrated skew towards the Mag 7, if they come in a little lighter, those will be the ones that get hurt, while the rest of these up-and-comers, remember that earnings growth starting to kick in, is going to be the story here that they're now inflecting, and money's going to flow and follow that. Is pretty exciting. Bankruptcy filings by month are moving up, so that's also going to put a little pressure on the Fed to go in September. Then you've got establishment, that's labor. We talked about that. It's ticking up. This is giving them cover, which is why you saw the odds of September go to 93%. Then if you look at labor force participation, though, this is a very positive development. 25 to 54, labor force participation rate is almost 83.7%, which is higher than it's been going all the way back to 2007, and the overall labor force participation rate is 62.6. It's climbing back up now that people are running out of the excess savings. This is good. More supply of labor keeps a lid on average hourly earnings, keeps a lid on inflation, keeps the Fed put in place. And you see here average hourly earnings rolling over. Man, we just give you so much data, ladies and gentlemen. ISM services was a little weak. So again, the Fed is seeing these things. Fed could slash rates by 200 basis points over 8 straight meetings as the economy heads for sharper downtrend, Citi says. I think they're being alarmist. I think they're wrong on that. I do think if they don't cut in September, that could be the scenario. But now it seems like they are getting their head on correctly. And if he gets this right and he does September, he may go down as the best Fed president in history, or one of them. If he dithers, then it'll just be a reinforcement of the mistakes he made in 2018 and 2020. But if he gets 2018 and 2021 and 2022, but he's got the window here. If he does it, he's going to be a home run. Look at emerging markets currencies starting to climb, like we've been talking about. What do we have here? This is S&P, first half of August. Russell 2000. All right, I don't understand that chart. Here is the Dow historically tends to perform well into August when incumbents win. I don't know whether incumbents are going to win in this case at all. So that chart might not be that relevant. This is the 52-week highs minus lows. This shows how one-sided the market has been, and that's going to change here, and you're going to see it flip to the exact opposite side with more and more participation. This equal weight is going to catch up. Maybe you'll get a little S&P catch down at the same time because of the Mag 7 start to take a breather. You don't have to crash. Again, this is not 1999, but I think the opportunities here, and so much money can be made in this. Even if this comes down a little bit, this going up is going to be fortunes. Equal weight relative to the S&P, this is now turning on the dime. Consumer expectations back to normalized level. People expecting that they'll lose their job over the next 12 months is going up. Again, this all is what the Fed needs to see to finally pull the trigger. Revolving consumer credit, owned and securitized disposable personal income. So this is not near pre-pandemic levels yet. It's climbing back to it. So the consumer's still relatively healthy. Japanese money supply year on year collapsing. I'm telling you, ladies and gentlemen, this was just a safe haven out of China. All this hot money into Japan and India is going to flow back to China. Hopefully, third plenum will be the catalyst. Seems like I'm running a hot hand now. Maybe we'll get the trifecta, and actually that'll start to happen now too. And that'll be exciting. We covered that. Five largest stocks in the S&P 500. So this concentration, I think you're going to see break up. It hasn't been this concentrated since 1964, and it came aggressively off the boil. And you had another 5 years of, or actually, I would say even to 73 of rally. So you had another, certainly to 68, and then you kind of consolidated a little bit to 72 before you rolled over. So another 4 or 5 years as the weighting, this aggressive weighting of top 5 stocks in 1964, like we have today in 2024, as more stocks participated, and at that time it was AT&T, General Motors, Exxon, IBM, and Texaco, took up less weight. The rally continued, but more started to participate. We're going to see the same thing. Emerging market equities versus U.S. equities at 50 years lows. That's going to change just like it did in 2001, which we've covered many times, and the early 80s as the dollar weakens, and we go through this. Here's from Seth Golden. It's rare. S&P has gained nearly 17% in the first, when up between 15 and 20 in a post-World War II era. S&P average gain the rest of the year is 8%. That's in line with what we're saying. Single digits, for the rest of the year. The indices are going to be more subdued, and fortunes, big money under the surface of the laggards starting to participate. But because their weights are so low in the passive indices, it won't be reflected in the S&P. So in other words, if you're in indices, you're going to be bored out of your mind. If you're in some of this great stuff under the surface, you're going to be smiling so wide you could eat a banana sideways. This shows the shares outstanding of Alibaba. This is awesome, from 2.7 billion down to 2.3. We're getting net reduction now, and it's gotten more aggressive since they had to ease up on the employee stock compensation program. So effectively, all that means is the Alibaba pie, you are getting bigger and bigger slices for no further money out of pocket. This is something that I've talked about in the past. I said not every 30-year-old needs a 6,000 square foot house with 7 bedrooms and an indoor pool. Think Levittown. Well, Lennar has gotten the message. They've got houses for sale at $197,000 in Texas, 700 square foot, 2-bedroom, 2-bath. This seems a little small. This might be an exaggeration, but I think if you go to 300,000 and you have a 2,000 square foot house, I think that's where the growth is going to be for these starter homes with 72 million millennials. The global growth wave is signaling an upturn in the economic cycle. This is pretty standard. You get out of these monster troughs like 2020, 2009, 1990. You get this rally over. This is like mid-cycle 95, cut back, and then you turn back up. You get multiple year runs beyond. This has never been seen before. The 3-month correlation between S&P 500 returns and the number of S&P 500 stocks advancing dropped to the lowest on record. This means the number of stocks driving the gains is the smallest ever. Notably, 40% of S&P 500 stocks are down year to date. Let me repeat that. 40% of S&P 500 stocks are negative year to date. That is going to flip upside down abruptly and very quickly, guys and gals. China's securities regulator announced several new measures, including suspending new securities, relending, and raising margin requirements for short selling in the latest move to shore up the sluggish stock market. So they want to see prices appreciate now versus being the poor kid on the block. Net immigration, this is a monstrous number, surged in recent years. Big time immigration here. I mean, it's tripled since 2021 alone. Cash levels moderated from 2022 peak. So these are short-term deposits. On a household basis, higher income households significantly more cushioned than lower income. Means they have to go to work. Labor force participation goes up, brings wages down. More than 50% of 74 U.S. CPI components now running below 2% year on year for the first time since 2020. Fed is paying attention to this. That's why they've been more dovish. Millions without power in sweltering heat after Beryl pummels Texas. Look, if you don't have a generator in Texas, I guarantee you this week you're going out to buy one. And that's one of the fastest growing markets and the highest penetration markets, which is ironic because you would think the highest penetration markets are saturated. I think there's 3% of households over 150,000 in the country have it. Some markets like Michigan and Texas that have a lot of power outages are, I think, double-digit penetration, but they grow at 20% a year. And I think that's going to continue here. And I think more and more people are going to be getting generators. So that's good for our Generac. You can see all these people, 2 million people sitting for days without power. So let's just call it 200,000, a million. You know, let's say half of them can't. But, you know, if it was 1 million people buying, I mean, that could be 2 billion in sales alone. So a lot of action happening there. We don't wish that on anyone, but, you know, once you have a power outage and you hear that humming in your neighbor's yard and their lights are on and you can see them laughing and watching TV while you're sitting in the dark with a candle like a schmuck, you're getting a Generac generator, and we're making coin because we own part of the company. 2024 hurricane season predicted to be particularly active. 2 big catalysts for Generac are 1, lower rates, 2, they've destocked, and 3 is hurricanes. Hate to say it, that's how they make their money. The more hurricanes there are, the more people buy generators, and this is expected to be a monstrous year, just like the year before they were, 2024, 22, when they had that huge run up to whatever it was, $400. Let me see. GNRC. Yeah, $524 when they had the last big hurricane season. So I'm not saying we're going back to 500, but you know, double's nice. But I think we could get another double if we bide our time and have some patience, which would be a quadruple for those of you paying attention at home. All right, election year seasonality. This is in a presidential election year since 1976. And this is the thing that, you know, it shows that we should see some weakness the second half of July, but then strength in August and September, which kind of is a little bit counterintuitive because normally you see weakness from mid-July all the way through mid-October, whereas in a presidential election year, you might get that July weakness, a little bit of weakness at the end, which will probably be concentrated in the Mag 7, but then strength through October, and then you get the weakness right before the election. So you don't want to miss this. This could be, so it's just being selective about the stocks. This was very interesting. This is U.S. energy consumption from 1776 to 2023. We are now, if you look at natural gas, basically almost overtaking petroleum as the top energy source. Renewables are, what's this in black is coal is rolled over. Renewables have flatlined. Renewables are going up modestly, nuclear, so more natural gas. And this, ladies and gentlemen, was in the Wall Street Journal today, which is what we've been talking about. This is where all the money's going to be made. The last parabolic move from 35, this is China's population, 2024, just updated. Largest portion of the population now, about 34, 35. And you usually have a parabolic move, final parabolic move from 35 to 40 years old in the stock market. You can look back at the US, you can look at all the developed economies, and that's why our view is we get one last parabolic move before China turns into Japan and they have 3 lost decades. But you get the blow off like they had from 85 to 89. I think we're going to have from 2024 to 2028, and then it's over for China. And we'll reinvest those profits in India, which has a lot younger population. But this is the name of the game, ladies and gentlemen. Put this in your wallet and look at it every day. This is the Slumer, thanks to my buddy over at RBC. You can see here small cap S&P 500. 1, yields rolling over. We know. 2, S&P like really pushing higher, but mid caps and small caps, huge upside opportunity to fill up the gap here. Emerging markets breaking out. Yeehaw. REITs, plenty of room to run. Utilities, same story. Regional banks, same opportunity. We love it. Here's an interesting headline that I just caught right before the podcast. Jack Ma reportedly shows up at headquarters for Alibaba regularly. Okay, so that is good news. He's back in the game. I thought this was interesting. Dodge & Cox is basically a mutual fund, but they did buy 7 million shares of VF Corp recently, which is a big ad at an average price of $13.50. So, not something to shake a stick at, give or take 90, 100 million bucks of new institutional money coming in when everyone else thinks they're going to zero. We're pretty excited about that one. Intel's momentum has flipped as the stock books 5-session winning streak. I guess people are tuning into Fox Business and hearing the thesis, ladies and gentlemen. It's hard to lose when you got a government, the world's wealthiest government in the world, backing you to create a duopoly against Taiwan Semiconductor. But no one wants it. You can't give it away. And we are happy to take it from those puking it out at $29 and $30. Milder inflation opens door to wider September cut. We got that. Inflation cools. Okay, we got that. U.S. inflation broadly cools, likely sealing the deal for Fed rate cut. Got that. Yen rallies. Is that an intervention or a squeeze? We don't care. The key is it's going up like we intended. Is the stock market rotation under the way? Small caps surge as Magnificent Seven are punished after cool CPI reading. Hedge funds seen feeling the pain as they unwind short bets against small cap and mid cap stocks. Bye-bye. Bye-bye. On to the next. Traders piled into bets against small cap stocks at exactly the wrong time. So sorry. Next, here is the Consumer Price Index month on month. First negative print since 2020, ladies and gentlemen. It's over. It's time to cut rates. Maybe, I don't think they're doing it in July, but September looks like a lock now. Good news. We got that. NVIDIA CEO cashes in on rally with 169 million share sales. So he upped it from 94 to 169, sold to you, those who bought the split. And by the way, was down 5% today. Those of you thought it was going back to new highs quickly. I think you're going to be disappointed. It's going to take some time for sure, if at all. China's PBOC readies multi-billion-dollar yuan pool of bonds to sell by tapping major banks. This was the key thing we covered in the last 2 weeks, and we showed that when the yields on Chinese bonds went back up, it had a high correlation with massive multi-year equity rallies in China. They're starting the game. China stays committed to opening up to promote reform, development, and innovation. Goldman Sachs upgrades UK growth forecast after a huge Labour election win. What's that good for? Our stealth UK play, 50% of revenues. GXO Logistics, ladies and gentlemen, one of Brad Jacobs' companies. We are ready for a multi-year multi-bagger on that one. Alibaba cloud service market in China for Q1. China's cloud service spending rose by 20% year over year to $9.2 billion in the first quarter, according to the latest data and market research Canalys. Market continues to be dominated by three giants: Alibaba Cloud, Huawei Cloud, and Tencent Cloud, which collectively grew 22% year over year and held 72% of the total market share. Alibaba Cloud led with 37% of market share. Woo, woo! Here we go, guys. And just the beginning. They are the hyperscaler extraordinaire in China. Taobao deepens integration with Elmei after suggestions Alibaba could sell the delivery service. By the way, they got $350 million for some business I didn't even know we owned. And they've got hundreds of those, ladies and gentlemen, that are not priced into the stock. Mainland China's cloud service spend grew by 20%. Okay, this is the official report from Canalys. You can read that on your own. China's central bank, hundreds of billions of yuan of bonds at its disposal to cool a long rally, which is going to ignite that. Our slip-on vans, the Sambas of summer 2024. The key thing in this article was that Google searches for the classic checkerboard styles of vans have increased by 5,000% in the last 90 days, while over on TikTok, videos about the trend have surpassed 41.6 million. And further proof of Vans' moment in style spotlight is the brand's collaboration with Proenza Schuler, a modern, luxurious reinterpretation of the iconic slip-on that dropped just last month. I don't even know what that means. All I know is it's not bad news. And then they show all these celebrities that are wearing Vans now. You got Emily Ratajkowski, Sophia Richie. This is the kind of stuff you want to see that we saw in the last cycle several years back. I don't know who this is. Avner Lewin. Anyway, who's this? Morgan Stewart. So all you young bucks and buckettes, you know who the hell these people are. Apparently they're important and they like Vans, which is good news. Baba offloads 3.9 million shares of cloud music to cash in $350 million. I didn't even know they own that. So it goes to show all the free money that's going to be coming to owners, and our share of the pie is going to get bigger and bigger and bigger without us even investing new money. Citi says it's time to book profits and high-flying AI equities. Okay. Sing it to the choir. Daily travelers passing through U.S. airport security top 3 million for the first time. The joke now is the consumer is so strapped they're living hand to mouth. Instead, it's the consumer is so strapped they're living airport to airport because they're still flying like nobody's business. Why China's third plenum matters for global investors. So what this article goes through in Bloomberg is all of the key things that have happened in previous plenum meetings from 1978 to 1984. 78 kickstarted the market-oriented economic reform. That's where they got thousands and thousands of percent return, GDP return since then. Stresses the importance of expanding economic reforms in 1984. Approves a plan to reform prices and wages, 88. Socialist market economy, 1993. Growth of rural economy, 1998. Encouraged expansion of non-public sectors and bolster property rights in 2003. That was the first big rally from 2002 to 2007. 2008 approves a plan. Rural households to transfer their contracted land rights, so more property rights. 2013, allow the markets to allocate resources and encourage private investment. 2018, they reformed the party. And now, what are we expecting from this plenum on July 15th to 18? Resolution on comprehensively deepening reform and advancing Chinese modernization. Policy direction along the fiscal relations. Okay, so to backstop the real estate market, help the private sector and the country's technology push. Watch list is fiscal reform possibilities, new round of fiscal and tax reform. Okay, property policies are another area of focus. Personal changes. Okay, so we'll see what happens, but it's a big meeting. That's all I can say. Hong Kong stocks rally after China unveils fresh curbs on short selling to boost confidence. China's plenum must offer action, not rote slogans. We agree. The golf putter that works so well, it feels like it's cheating. This one brought me down from a 15 to a 12-2 in a matter of weeks. So read this Bloomberg article if you like golf. I have no skin in the game, but it's helped me. Okay, next, Alibaba AI model outperforms Chinese rivals, OpenAI and Anthropic. So Alibaba's AI model is better than all the Chinese ones, and it's third in the world behind OpenAI and Anthropic. Big deal, guys. So moving on, China's weight loss pill is back. The article says too little, too late. Might be interesting. This is very similar to the NVIDIA's hold on the market. So Lilly had, the two starters, Ozempic and Wegovy, had share. More and more coming online. It's going to get cheaper. It's going to become more widespread. The duopoly is going to unravel, whether it's Pfizer or someone else. And the same thing will happen with these AI chips and GPU chips for sure. Now, on to the article of the week. Is it time yet? Stock market and sentiment results. I think we got our answer. I mean, I posted this article at 7 a.m. and by 9 a.m., I think the market answered, you bet. Now, here's the article. I find more value in looking at individual companies' fundamentals than focusing on macro, Fed, etc. The reason is, one you can control and one you can't. You can control your investing framework, analysis of fundamentals, and apply it consistently across opportunities that meet your criteria. You cannot control the timing in which companies that fit the bill inflect from undervalue to overvalue. Some do it in a year, most take 2 to 3 years, and some take up to 5. But over a concentrated book of 8 to 12 good companies with inflecting or growing free cash flow, you can see meaningful results over a reasonable amount of time. About 36 months is the right window. The stock market is a device for transferring money from the impatient to the patient. That's Warren Buffett. We cover that, at least once a month just to keep you reminded of what's important. If your framework is sound, it works like all other immutable laws. Gravity works just about 100% of the time. If you drop a ball from the top of the building, it goes up approximately how many times? 0, give or take. If you hold a beach ball underwater against its natural level, when pressure is released, the rebound is abrupt. For every action, there's an equal and opposite reaction. That's Isaac Newton for you. For us, we like to focus mostly on high-quality companies that have a long history of performance through many different macro cycles, and because of their business moat, have strong recoveries when they emerge from their cyclical troughs. We generally avoid companies that start with if and lean into companies that start with when they recover. This mosaic of analysis comes from many years of experience, solvency analysis, cash flow analysis, and durability analysis. Once that aspect of our process is satisfied, we run through 2 final filters to manage risk. Number 1, if this position goes to 0 as it relates to quality and size in the context of the portfolio, will they take me out on a stretcher? The answer must be no. Number 2, if I raised the capital to buy the entire company at the price it is quoted in the market today, would the board be insulted and have me escorted off the premises? The answer must be yes. Imagine if I walked into Bracken Darrell and said, I'll buy your whole company at $13 a share. I mean, the guy would literally think I was nuts and call the cops. The first question addresses the possibility that there's something that we don't know and probably can't know. There is no way to insure against this low probability scenario. It ensures humility and acknowledges that there's no such thing as a sure thing. You manage around that risk by 1, owning multiple companies, but not too many that you can't outperform over time, and 2, very limited leverage. By sticking with rigor to a long developed process, you do not worry about short-term day-to-day fluctuations or for, quote, macro events to catalyze the price movement. You simply know that over time, price will always catch up to fundamental performance. On the long side, this means that as fundamentals consistently improve, i.e. the earnings power and cash flow increases while the price stays the same or moves down, when it ultimately moves, the price movement to catch up will be abrupt to the upside. This is an immutable law like gravity. We saw some early indications of abrupt across many of our positions today. Ralph Waldo Emerson had this truth in mind when he said in his essay on compensation, quote, "If you serve an ungrateful master, serve him more. Put God in your debt. Every stroke shall be repaid. The longer payment is withholden, the better for you. For compound interest on compound interest is the rate and usage of this exchequer." And what he's effectively saying is, you know, it's like a stock that you keep putting in more and more work and getting more and more results and your pay doesn't go up. And then when it does go up, it goes parabolically because eventually the value is realized in the market. And that goes for individuals' labor. It goes for an individual stock price. It goes for many things. So that it goes for, you know, swimming. I remember taking my kids to to meet all these medalists in Nebraska for the Olympic trials a couple years ago. And they were telling a story like you're going to go through periods where you're working harder than ever and your times just don't drop, but you have to think like you're making deposits in the bank and those deposits are collecting interest. And then all of a sudden, it could be 12 months down, it could be 18 months down, it could be 24 months. You drop 2 seconds and you're a new champion. And it's just the way it works. And that's the reason most people don't become champions is because they can't sit through that 12 to 18 months. And it's the same thing with stocks. If you want to be a champion in this business, you got to have ice in your veins. And if you don't have ice in your veins, you got to hire someone who does to take advantage of these opportunities that come up. So, parabolic moves into what fundamentals. Okay, extreme example of this is the late Charlie Munger's pick of Chinese automaker BYD. He persuaded Warren Buffett of Berkshire Hathaway to invest in it in 2008 and 2009. Here's what happened. And this is mind-boggling. This is, if you understand this, you've learned more than 99.9% of people who will ever participate in markets. They suffered drawdowns of 87%, 61%, 58%, and 62% before finally realizing a 21-bagger, 2,000+% return. After 12 years invested, they were only up modestly after 12 years. And when it came all at once from $8 to $83 was the final big blow off move. And they laid off a bunch of it up here, by the way, if you've been paying attention to the headlines. Why were they able to hold tight when everyone else was puking out in the hole 4 separate times? Number one, low leverage. They weren't getting stopped out chasing price up and down and getting fooled out by headlines. And number 2, the fundamentals were improving even when price wasn't. You can just see year after year, the revenues were going in the right direction. The same is true for stocks that are, oh, and by the way, what was the key turning point here in 2020? They turned from cash flow negative to cash flow positive, and the thing just went off the charts. So the same is true for stocks that are excessively overvalued, and the stock price has continued to go up while the underlying fundamentals have deteriorated and then all of the sudden it collapses. The key is to do the work under the hood and use your x-ray glasses to find these opportunities. Then execute and wait across a basket of 8 to 12 great opportunities. Some will move higher, faster than expected. Some will be doubles, and some will be 10x plus. Some will take longer, but ultimately make you a higher IRR. Some you will be wrong, but if you bought with a large enough margin of safety, you can reallocate to better opportunities. But in aggregate, you will have leveraged these immutable laws to outsize success. And with that said, let's get to the macro. So then we went into these three clips that you already saw, and we can cover that. And then we made the case as to why Powell is going to cut. And then today that was confirmed by the data. Retail investors getting a little bullish here. I think they're all crammed into those 7. Those are going to take a breather, and the rest are going to gallop up, and they won't participate. They'll just get smoked in the indices and in those. On balance, it's still quasi-neutral here. And then National Association of Active Investment Managers, they're all crowded into the most crowded trade right now is the Mag 5, Mag 7. Those should get hurt a little bit or cool down while everything else gallops higher. Now, congratulations to all the new clients that came in during our early Q1 and Q2 raises. We are now reopening to smaller accounts, the $1 million plus accounts again, starting today, and will remain open for the next 2 weeks. And then we'll close again, and we'll revisit potentially in Q4. To see if you qualify and to take advantage of this opening, click here. You can just go to hedgefundtips.com and click on this money management button and fill out the form there. And larger accounts, 5 and 10 million plus, can access bespoke service at their preference anytime by contacting us. This is all opinion, not advice. See terms, and it's not a solicitation. Only available through private placement, member, random to sophisticated investors, etc. All right, now let's get to earnings. Consumer staples, top 30 weights. This is pretty interesting. Earnings revised down 1.86 for this year, 1.90. So we got to keep an eye. We'll see how lumpy that was as we go through the components. You can do that on the website. Consumer discretionary got hit pretty hard, the earnings. So we do have to keep a little bit of an eye on it. What went down is Amazon. And part of the reason we trimmed, even though we think it's going a lot higher over time, is Bezos has been selling a ton of stock, and their earnings have come down. So I'm inclined to follow the leader on that one after making such a huge run since 2022. We want to keep a bunch, but we also want to take a lot of our money off the table and just run the house's money. Earnings power of these 30 stocks was revised down 6% in the last 60 days for both years. So let's see where that pain's coming from. Certainly Amazon, Tesla is down. Let's see here. Booking. Okay, so that's probably skewed because of the dollar value. So that one we got to just... So Booking. All right, so that might be more of the story than anything else. Nike. Okay, Nike may start to get interesting. Starbucks. And the rest look pretty darn good. Okay, and some of them are going up, so that's good. Yeah, it's really that Booking kind of skews it. That's an abnormal thing. All right, so on balance, they actually look quite good. If you back out Booking, but a little bit of weakness again in the Mag 7. That's where I think you're going to see a little softer situation. Economic data, all you need to know is that. And by the way, we're going to get PPI tomorrow. If this comes in weak, that's a leading indicator of what's to come. Producer price indexes, so that'll just be more questions from our viewers. We've got a ton, so this is going to take a while, but I think you're going to learn a lot. Really like the stuff. This is from Stephen Frampton. Stephen's been a long-time listener, multiple-time caller. Really like the stuff you post, learning a lot. Share it when I can. Wondering if you could look at a stock I own, North American Construction Group, NOA. All right, let's take a look, my friend. NOA. And And let me get stock chart. All right, so this has had a huge run. Looks like it's breaking out some new highs, I guess. All right, revenues are accelerating. Margins are choppy. Debt. Let's see, free cash flow is turning down. Let's look at financial analysis. All right, let's take a look here. Revenues peaked. Now they're reaccelerating a little bit. Let's take a look at, let me make this smaller so we can, yeah, there we go. Shares outstanding, they're buying in shares, that's good. Let's look at the balance sheet. They got some cash, 59 million, debt, they've got a $500 million. Not great balance sheet wise, that's a little concerning. Cash from operations holding in strong. Free cash flow. Yeah. Steven, for me, this is not exciting at these levels. It doesn't mean it doesn't go higher, but I don't have I guess you're asking, do I hold? And my answer to you is I don't. All right, so you have some insider buying. Big fleet of those giant yellow dump trucks and rent them out to natural resource infrastructure projects. It's not a great quality business. It's pretty low price. I'm going to say I'm neutral on this one. Let's just put it that way. I'm not a seller. I'm not a buyer. If I was looking at it with fresh money, I would pass. If I owned it, I might hold it for the longer term, but there's so many other great opportunities right now. I wouldn't be super excited about that one. But I think, look, I like your analysis. I can't find anything concerning other than the balance sheet a little bit, but if rates are going to come in a little bit, they'll probably get that done. So just check out the maturities on that $500 million. If those are okay and you want to hold it because you don't want to pay taxes, without really diving deep, I'd probably say, yeah, hold it for a while, see how they do quarter to quarter, but watch it closely. Jim Jones. Your podcasts keep getting better and better. Thank you. So he's asking about StoneCo, which someone asked about pretty much every 3 weeks. And Pagura, Pags, they also ask. The issue with StoneCo and why we haven't done anything with it. Yeah, I mean, it's basically a payments processor. Let's see how their fundamentals are doing here. They keep growing. Yeah, if I'm not mistaken, there was some accounting issue with them a while back, and that really worries the hell out of me when we're dealing with emerging markets. So they got $1 billion of debt, a ton of cash. I'd like to know why their cash from operations was down 400 million. If that's accurate. Change in net operating assets. So I want to understand this part of the cash from operations. Why did that turn negative? Why is their free cash flow negative? If that's an accurate number. Sometimes the numbers don't translate over correctly. So double check that. That seems to be problematic. But yeah, I want this is go time for international, guys. This is going to start to happen in a big way. I've expressed it in the ways that I feel I have the best, upside opportunity, downside protection, but there are going to be other opportunities as well. Just get your head around that negative free cash flow and cash from operations. What changed? Is it temporary or permanent? You got to do 8 or 10 calls. Really study management and their background, because you just never know with these smaller emerging market companies. You're taking country risk, you're taking political risk, you're taking company risk. I mean, this is not Alibaba, this is not Tencent, this is some tiny company in Brazil. But just looking objectively at the financials, it's worth doing the work. So nice find, good luck with it. Probably a pass for us, but I think you can make some money there after you do the work. Hairdo Bronze. Okay, I'm going to assume that's not, it might be the real name. Hi, Tom, a long-time listener. Oh, Hardu. Please excuse me if I'm mispronouncing Hardu. Long-time listener, appreciate the insights you share, by the way. Last year you talked Bank of America and Citi. What's your opinion on these two now? I think they could take a breather, but we have no reason to sell them. The M&A, IPO, financing cycle hasn't even begun. I think they can still go higher over time, over the next 2 months, 3 months. I don't know. They should pull back a little bit, but I don't know when that's going to be. But I like them for the long term. John Lee, and we covered him earlier. Lovesack. Thanks for sharing your content as always. This is a furniture thing. There's going to be a pony in the pile with these furniture stocks that have just been left for dead. I think there's Leggett and Platt and Lovesack. So they're turning cash flow positive. Revenues are up. Gross margins are reaccelerating. It seems like consumers love their products. Let's see. Looks good on the surface. Let's see what's under the surface. Revenues decelerated. See if that's correct. That could just be a seasonal thing because it's last 12 months versus fiscal year. But it looks like they continue to grow. Share count is also growing. Not ideal, but fine. Let's take a look. LOVE. All right, they are generating free cash. Let's see, gross margin. Gross margins are holding in there. I think you might have something here. Let's take a look at the balance sheet. Nothing. I think this one's worth looking into. You really have to understand what's their competitive advantage, because these things like Lazy Boy and all these companies, they just go like they're not good quality businesses where like they're just so hard to understand the fads of the public. But if you can do it, you probably have a shot for a nice recovery here. It seems like it's strong. Just understand how do they continue that? What is their advantage? Why do people like it? And you really got to dig deep on this, because these things are like this business. Here's my bet. LOVE ticker will not be here in 10 years, okay? So the question is, what part of the cycle do you catch? And maybe you're going to catch a new cycle here. It looks like you might, but like, what's the moat? Like, I can probably go into their thing and copy the thing. Costco could do it, sell them in their stores under the Kirkland brand, and it's off to the races, and probably get them from the exact same factory in China. Billy Harrison, hope all is well. Okay, so this guy's talking about GXO had under-the-radar news. There's no under-the-radar news. If you have a Bloomberg terminal, you see everything. And that's where all the institutional money is. So authorities seized 84 million euros. Not concerned, question mark. Market didn't react. I don't get it. How can this be overlooked? Should I have stayed mum? No one gives a shit. It's a rounding error, okay? It's just the Chinese authorities trying to hustle tax money like every single government does. So they'll work it out. They'll settle for a few $1,000,000 and on to the next. And they'll probably pull some operations out of Italy because they know the government there is trying to extract excess money from them. So, or if they owe it, they'll pay it. But look, this is $11 billion a year top line, if they settle for 50, again, it's a complete rounding money. It's lunch money, and it's what governments do. They see a honeypot and they want some of it. That's the way the world is divided. You have producers and you have extractors. And here's a case: GXO is a producer. The Italian government is an extractor. They want a piece of that production, and it's a constant push-pull that's been since the dawn of time, and will continue to be for eons and eons forward. Even if we colonize Mars, it will be the same issue. You'll have your producers and you'll have your extractors, and that's just the way the world works. And that's your example, and that's why the market really does not care. Tim Felmingham, thanks, Tim. Relatively new UK listener to your podcast. At 6 months or so, become a weekly must-watch. Thank you very much. I don't believe there's anybody who puts out as much quality information as you do, and you don't even charge for it. Thank you so much. You've made a big difference to my investing, and I appreciate your generosity. Okay, here's your question. Thank you. Glad to do it, but you should really thank my investors, because it's because of them that I am in a position to do this great thing, although I was doing it before them. But so that good karma that goes out from me being able to do this, it's also coming back to them, and I think they know it, and it's going to continue. So the question is, you've talked a lot about how you expect the non-magnificent 493 to outperform the top 7 in the second half of the year. Is an equal weighted index ETF a good way to play this? Yes, that small cap ETF. Are there any ETFs for you to play like this, or is it solely stock picking? No, I solely stock pick. Yeah, so look, I can't speak to your financial situation. You're probably fine in everything you are, but if you wanted to play this theme after talking to your financial advisor, you could do it through an equal weighted ETF and a small cap ETF, and that'll be fine. Thank you, and great stuff. Welcome. Oleg Shakarov, curious on your thoughts on CLF, Cliffs. Let's see here. CLF. Yeah. I want to like this, and it'll probably have another cycle here, but I'd prefer to ride Comstock and get a multi-bagger versus a double with a lot of headaches. Thing about this is it's such a low margin business, and it's just, I like the CEO because he always goes on CNBC and curses and yells at the host, but not that I think that's a good thing. I don't approve of that, but he's funny. Let's just put it that way. I mean, he's certainly an independent thinker. I mean, I don't like all these shares. Why does he keep issuing shares? This is bad. Don't like. From 250 million shares to 500 million shares in 5 years? No bueno. I don't like that. I think the business will do okay during this part of the cycle. I just don't like that. I mean, he's a cash machine, so God bless. Let's look at the margins. Margins are collapsing. I don't love it. I know a lot of value people love it. I mean, this is the type of thing I would be buying in the hole in 16 or 18, like when you could buy natural gas stocks. I think it probably continues for another few years, but I think there are better plays like Comstock Resources. Okay, next. Edgar saying, hello from Hong Kong. I've been a fan of your work. I've been following you since the start of the year. What's your opinion on Nissan Food Stock, the king of cup of noodles? They're listed in Japan and here in Hong Kong. Can't go anywhere in Asia without seeing their product. Their staple like Coca-Cola stock's taking a beating, possibly due to their expansion in China. All right, Nissan Foods. Let's see. I know those noodles from college. And I was poor and hungry. Good combination when you're starting a career. I don't want Japanese stocks. I'm just telling you that right now. But can't even bring it up. All right, so this has had a huge run. I mean, yeah, it's off its peak, but all right, revenues continue to grow. Margins have contracted. Let's look at some of the financials. Revenues have basically been flat for years. I hate these are where you can get caught in value traps. Shares outstanding, good. They're keeping them flat. Let's see what's happening with free cash flow. $500 million from operations. Free cash flow, $200 million, but it's been flat for 4 years, pretty much. It's actually declining a bit. Return on capital. It's kind of a low quality, boring business. I hope it has a big dividend. Balance sheet, probably good in Japan. Yeah. I don't think this has been beaten down. I think there are better options for my money. I like how you got here, Edgar. I think it's okay. I just think there are better opportunities, but keep listening. I think you're on track. D6 from Twitter said, asked me to submit it. I love your work. Thanks in advance. What are you thinking on Intel stock here? Where's the take advantage of the chip acts? Cheaper than semiconductor peer. Yeah. By the way, we did. Okay. So D6 is asking about Intel. Intel's a position. We were pounding the table on it last year at 25. We rode it up to 48, sold a bunch, and then we bought back what we sold at 48. We bought back at 29 and 30, and now it's running back up. Go to hedgefundtips.com and click on commentary. That's where you can see all of my old articles. I think we did a whole week on Intel. Here, what I'm thinking about now, stock market and sentiment results, June 11th. And then if you go to the sidebar here, Intel, just type in Intel and you'll see everything we've ever written about it. And 100%, we love it. The government's creating a duopoly. The legacy business is worth $45 to $50, which is the PC and servers chips. You got the huge AI PC refresh going on right now, and then you got the free option on their advanced chips like Gaudi, and half the price, 40% more energy efficient, 50% faster. So yeah, 100%. I couldn't agree with you more. And we've been covering that one for weeks. And before that last year at $25. So Daryl McDaniel, I believe you were long the regional banking ETF. Are you still long this? Yes. I have bought TFC Regional Bank around 35. I was wondering your thoughts on it. What is that, Truist? I'm not going to endorse any individual regional bank because I don't know which of them have the most hair, and I don't want to play that game. So I'm going to say pass. I mean, I explicitly bought a basket of biotech and explicitly bought a basket of small regional banks in the hole when we had that thing, whatever it was, the Silicon Bank crisis. And that's how I play those massive dislocations. I don't try to bet on the one. I bet on the basket because it's so dislocated I can get the same upside with spreading my risk, assuming there would be another Silicon Valley Bank. And I think there might be a few of these banks that that get hurt by some of this commercial real estate that have lower quality properties in their portfolio or their bond portfolios upside down. So I don't want to pick one. Not doing any real work on it. I think Truist is okay, but it's already up double off the bottom. So I still just like the basket. Okay, how about the entire family watching? Thank you, Daryl. I think you're okay with that, but we played it that particular way for that particular reason. Because I can't get, my X-ray vision can't work clearly enough under the hood of these biotech companies because I can't predict the approvals, and I'm not a scientist and all that stuff. So I buy a basket when the whole sector gets dislocated. And the same thing is with bank balance sheets with these regional banks. Like I can, best way to play those is wait for massive dislocations, buy them in the hole. Some will go bankrupt, but you own the basket, and then you just, you double your money in a couple of years and you get out and do it again the next cycle. Ron Stewart, thanks for all the knowledgeable information. Wondering what you think about Alibaba being the official sponsor of the Euro and the Olympic Games. I know just Olympics, they've paid $800 million. I would say there's better use for that kind of money, but I wanted to hear your opinion. I could care less. I mean, it's branding. I mean, at least they're playing the game. They're executing. It's when China flips the switch, when these things happen like what happened today, they're going to just rip roar. It's the best game in town, best way to play it. A lot of outs. We've covered that in the past. Some of the parts, et cetera, et cetera. Bob Smith, where you get new data on car sales for the Cooper Standard. I think Manheim, and I talk to a lot of dealers. They're all members of the club. I talk to them all the time and grill them. But Manheim, I think, was the thing that we showed. We show it on the podcast. I think it was 2 weeks ago, one of the data points. And we look at that once a week. Christine Najad, first time asking a question, watching your videos over a year. Thanks for the great video cast. Thanks for watching. And thanks for everyone, by the way, who had the courage to submit a question and has been watching for a long time. Was wondering if my assumption that Alipay is more valuable than PayPal is right. Alipay has 1.3 billion users. We'll change those customers since they have amazing incentives when you use Alipay. 1/3 the size of Alipay in terms of... Okay. I would value PayPal around 80 billion. Alipay Ant Financial around 200 billion, which is way less than the 300 billion. Let me know if I'm missing something. Christine, I think you're right that 5 years from now or 3 years from now, Alipay will be valued back above 300 billion, and PayPal may also be at least 200 billion, maybe 250. So probably Alipay will be worth more because it's basically the largest financial service business in Asia, and we own 1/3 of that through our ownership in Alibaba. So I think you're right on Alipay. Not now, it's not marked to 200 billion now, but it will over time. It'll grow into that. and then let's call it 300, billion, 100 billion of that will be attributable to Alibaba owners, which is really not meaningfully priced into the stock. But I think you're underestimating PayPal and the initiatives of Alex Chris, and I think that one's going to be a surprise multi-bagger to the upside as well. So Will Kuharski, you have said on previous podcasts you like REITs. What are your thoughts on MPW? The only REIT we own is Crown Castle. MPW is probably medical properties. These things have been garbage. I would imagine that this is trading like this still because their balance sheet is really in trouble. So for me, I'm going to just pass. The name of the game is, their cash flow has been declining, and I'm sure their balance sheet has been not doing well. Additionally, let's see, 224 million of cash and $9 billion of debt, backed by properties that are probably worth less than they were when they bought it. So hard pass for me. Ronan Bitten, Ronan from Israel, would appreciate your opinion on PAG stock. The reason I think you're going to be right, Ronan. The reason we're not pounding the table on that is because it deals with consumer credit, and there's no way to tell what's in their portfolio, and especially a small company. But I mean, look, on paper, this thing is a home run. I just can't get the granularity and confidence. I think this is a punt that you put in your personal account. I can't take a serious position on something like this without having full transparency into their loan book and their exposures, despite the growth, despite everything else. So I think from an individual investor, you take this as a speculative position and you'd probably be very, very happy with it as emerging markets start to rip. But there's not enough transparency for me to lean into it as a big client holding. I can't get. It's like owning a regional bank, in an individual regional bank, and let's just see something here. Solutions for micro merchants. Yeah, I think if you get a little softness in Brazil, you're going to have a lot of defaults. But it's priced in a lot of bad news at these levels as well. So, again, I like what you are thinking. I agree that you're probably going to be right. I can't own something this risky in scale, but I think you put a small amount. Check with your financial advisor. Opinion, not advice, but I could definitely see having a bunch of this in a personal portfolio in a size that if it goes to zero, you don't lose sleep, and if it winds up at $50-$60, you make some money. I think that's the binary nature of this one. Hope you had a great holiday. Skechers, interested to gain your thoughts on Skechers and Waystar Holdings Corp. All right, Frank, let's take a look. Skechers. Wait, Skechers. I think that's owned by someone else. Who owns? What's the ticker here? Oh, SKX. I don't buy things at highs, so for me it's pass, but let me just take a look at the fundamentals. So if you own it, we can see if it's worth holding. I mean, this is the type of business I would have been interested in, down here when it dropped from 44 to 20, from 55 to 31. Not after it's just doubled in, a year. SKX. But I'm old school. I like to buy low, sell high. All right, so their cash flow reaccelerated. Now it's declining again. Revenues are strong. Gross profit margin. Like what I like to do, I think Skechers has had like a big run. What did it? Do they own Hookah? Who are the Skechers brand? Let's just see here. This isn't the Hookah company, is it? No. All right. So I don't know who buys these, but all right, so let's take a look here. Revenues are growing like a weed. Share count staying steady. Let's take a look at cash flow. It's growing. Free cash flow solid. $15 times next year's earnings. One-time sales. I mean, you could be okay here, but you got to just convince me why these sneakers are going to stay hot, because they all run in cycles. And so we're buying Vans at the low of the cycle and it's starting to turn up. This thing's had a run for years. I think that, you know, when you see Nike getting smoked, so it's like the popular ones are getting hit and the unpopular ones are starting to come back. This is a popular one. So look, if I owned it, I'd probably hold it. I wouldn't personally initiate a new position at these levels, but I'd keep it on a watch list because it does have quality financials. Thank you for that. Garrett Kierzo, a pleasure to listen to your podcast. In my free time, congrats on your rotation. Yeah. If you had a little cash on the sidelines, would you allocate it to SPX QQQ puts as a hedge? Against continued large cap tech decline. You know, we don't have a lot of exposure anymore to Mag 7. We trimmed out of Amazon and Google, which we had monster runs from October 2022. So I don't have to hedge that. I don't own indices, which are skewed in there, so I don't have to hedge them. Small cap biotech indices continue to ride the wave. Yes, they're just getting started. So if you're overweight exposed to indices and you want to put a hedge on, I mean, this is opinion. I would wait a few weeks and see. Like, you're just guessing. It's kind of too late in the sense that it is and it isn't, but the implied volatility on those hedges went up dramatically today, so you're kind of late if that's what you're going to do. I would be inclined to wait for a few up days before I even considered doing that, and that's only if you have dramatic long exposure because you're overweight indices, which are overweight these stocks. If you're not, and you're in companies that are just now starting to gallop, don't even worry about the general market. Let the market correct 10%. Who cares? I mean, so I don't like the risk reward as much as when we had that successful tactical trades earlier in the year. That was more obvious to me. I would like to see a big, if we got, like, I think we'll get some weakness end of July in those things, which is going to affect the indices. But if we have a big rally into, like, if we have strength in August and September, which would be counterintuitive, I'd be inclined to put on hedges ahead of the election for those 4 weeks. And I think they're going to be really cool opportunities the end of October. So if we put, like, right before the election, I remember in 2016, I made so much money. I think it was like when Trump was running against Hillary, small caps got freaking destroyed right up into the election date. And I remember buying a ton of options on the small cap index, and it was like Trump got elected, and this thing, it was like, I don't remember, it was super huge multi-bagger in a short period of time because it just got so extreme. I'm like, this is bananas. Like, no president has that much power because they're going to have gridlock anyway. And that was a beast of a trade. So I would be inclined to just hang tight and see how the summer plays out. And the best case scenario for putting a hedge on would be as if we see continued strength into August, late August and early September, after we get any end of July weakness. And these are all guesses. But for what we own, no, it doesn't make sense here because our things are just getting going. What are we going to hedge? Like, it makes no sense. But if I was stuck in index funds, yeah, I'd probably want to have some type of hedge. So with that said, I want to thank everyone for tuning in. We'll be back next week, same time, same place. In the meantime, make it a great one. Bye for now.